Welcome everyone to Bodhi Unified Flow. I'm your host, Dr. Mari Muthu, and this is where we simplify complexity and amplify performance. Today, we're pulling back the curtain on the guardians of the Indian stock market, the crucial bodies that make sure it all runs fairly and smoothly. We're going to break down exactly who they are and why they matter to every single person who invests.
So here's our roadmap for today. We're going to start with the main player, the apex regulator, SEBI. Then we'll look at its key partners, like the RBI. After that, we'll dive into who's on the front lines every single day, the exchanges themselves. We'll also see how justice is served when things go wrong. And finally, we'll take a peek into the future of market regulation.
By the time we're done here, my goal is for you to have a crystal clear map in your head of this entire regulatory system. You'll know who's in charge, what their specific job is, and how they all work together to create a market that's fair and stable for investors just like you and me.
All right, let's dive right in with the big one, SEBI. You can think of SEBI as the ultimate referee for India's entire securities market. At its heart, SEBI's fundamental job is to be the market's watchdog. Its entire reason for being is to make sure the playing field is level for everyone, from the largest institutions down to the smallest retail investor, and to ensure fairness and transparency in every single transaction.
What's really fascinating here is that SEBI didn't start out as the powerhouse it is today. It actually began in 1988 as more of an advisory body without many real powers. But as the markets grew and faced new challenges, it was given real teeth in 1992. Then it got even more power in 2002, transforming it into the strong, independent regulator that we all rely on.
SEBI's entire mission really boils down to three key roles. First and foremost, it's a protector, looking out for you, the investor. Second, it's a promoter, actively helping the market grow and develop. And third, it's a policeman, regulating all the different players. It's a constant, delicate balancing act between these three crucial functions.
Now, this is what makes SEBI so incredibly unique. It's a three-in-one powerhouse. Think about it. It gets to write the rules, that's the quasi-legislative part. Then it can investigate if those rules are broken, which is the quasi-executive part. And finally, it can even pass judgment on the rule breakers, the quasi-judicial part. This all-in-one structure lets it be incredibly effective and super responsive.
But here's the thing. SEBI isn't acting alone. It's a key player in a much larger ecosystem of regulators. And one of its most critical partners is the nation's central bank, the Reserve Bank of India.
And this slide really shows you that clear division of labor. SEBI's focus is laser-sharp on the securities market. We're talking stocks, corporate bonds, mutual funds. The RBI, on the other hand, is looking at the much bigger picture, the health of the banking system, government debt, and the country's overall monetary policy to keep the whole economy stable.
And this is where you can see just how powerful the RBI's influence is, even though it's indirect. When the RBI decides to change interest rates to, say, manage inflation, that directly changes how much it costs for companies to borrow money. Cheaper or more expensive loans affect their profits, which in turn impacts their stock prices. So the RBI's decisions create these huge ripples that are felt across the entire stock market. All right, so we've seen the big picture view with the RBI. Now let's zoom right down to the front lines, the stock exchanges themselves. They are not just places where trading happens. They are the market's first line of defense. So here's a quick look at India's two heavyweights. On one hand, you have the BSE, Asia's oldest exchange, dating all the way back to 1875, famous for its Sensex. And then you have the much newer NSE, which kicked off in 1992 and totally revolutionized electronic trading in India. Today, it's the leader in trading volume with its flagship Nifty 50 index. Both operate under SEBI's watch, but each has its own distinct personality.
Okay, this is absolutely key. The exchanges act as self-regulatory organizations, or SROs. What does that mean? Well, in simple terms, they police themselves and their members. They are that first line of defense, making sure companies are disclosing what they should, that brokers are playing by the rules, and using some pretty high-tech surveillance to catch any funny business. They are active guardians of the market's integrity, day in and day out.
But with all this power in the hands of SEBI and the exchanges, you have to ask the question, right? Who watches the watchers? This brings us to the absolutely vital system of checks and balances that ensures everyone is held accountable.
The answer to that question is the Securities Appellate Tribunal, or SAT. This is the place you go when you believe a regulator has made the wrong call. It is, without a doubt, a cornerstone of fairness in our entire financial system.
Essentially, the SAT is a special court created just for this purpose. If any person or any company feels they've been wronged by a decision from SEBI or even other big regulators in insurance and pensions, the SAT is where they can go to get an independent judicial hearing.
And this lays out the very clear path to justice. First, a regulator makes a decision. If someone disagrees, they have 45 days to file an appeal with the SAT. After the SAT makes its ruling, there's one final step, an appeal to the Supreme Court of India. But, and this is a really important detail, that final appeal can only be about a question of law, not the facts of the case. This system makes sure that regulatory power is always under judicial oversight.
And finally, let's look ahead. Let's talk about what might be the next great evolution in India's market regulation. A massive move to simplify and consolidate the laws that govern everything.
You see, for years, the market has operated under 3 separate foundational laws, each from a different era. What's being proposed with the new Securities Markets Code is a huge undertaking to repeal all 3 of those old laws and merge them into a single, modern, and unified legal framework.
Now, this new code is so much more than just a cleanup job. It's a full system upgrade. The whole point is to make regulations more consistent, speed up investigations, and even statutorily separate SEBI's investigation and judgment roles to make things more transparent. It also aims to make doing business easier by shifting minor violations from criminal offenses to civil penalties.
And this really brings us to a big, forward-looking question, doesn't it? Is this legislative overhaul the foundation that's needed for India's next decade of growth and deeper integration with global markets? It's a strategic move, no doubt, designed to prepare India's capital markets for a future that is more complex and more interconnected than ever before.
So let's bring it all together. We've seen this sophisticated, multi-layered system of guardians all working in concert. You've got SEBI right at the top, the RBI managing the broader economic environment, the stock exchanges on the front lines every day, and the SAT ensuring crucial judicial oversight. And it's a system that's constantly evolving, with this new unified code on the horizon.
And there you have it. You now have that clear map of who regulates the Indian stock market, their distinct roles, how all the pieces fit together to protect investors, maintain integrity, and ultimately drive growth.
For those of you who wish to dive even deeper, these are the key legislative and analytical sources that informed our explainer today. Thank you for joining us on Bodhi Unified Flow.